This is a not about two brothers like the Hunts trying to corner a market. And the interesting thing is it's the same situation. The Hunt brothers noticed that there were more paper contracts than there were bars behind it. So let's buy the paper, stand for delivery.
What if silver breaking every price record isn't the real story at all? What if the real signal is a pattern hiding in plain sight? Silver just made history, but the bigger question is why. For years, experts brushed it off as irrelevant, even though it quietly kept its place in the system. So why would JP Morgan, America's most powerful bank, spend years hoarding physical silver since 2011? And why did three of the world's largest bullion banks suddenly change their rules? Within just 26 hours, HSBC, JP Morgan Chase, and Scotia quietly updated account terms, restricting how much physical silver customers can withdraw, although there was no announcement. That kind of silence usually means something bigger is coming. For the past 14 years, something significant has been building beneath the surface, even though most people haven't noticed it. After studying every major financial crisis in history, a clear pattern keeps showing up, and it always unfolds in the same four stages. That pattern has never really failed. Right now, silver appears to be entering the final phase. There's still a choice to be made, but the window for that choice is closing faster than most people realize. This isn't financial advice, just an analysis of how these patterns tend to play out when you line the facts up. The first stage is always the setup. This is when the system creates an illusion of stability. Prices are kept artificially calm, markets look orderly, and confidence feels high. Behind the scenes, the market is flooded with paper promises instead of real assets. But everything seems fine as long as nobody questions it. With silver, this process started decades ago. Regulators and financial institutions became uncomfortable with price swings, so they built an enormous paper market around it. A simple way to picture it is like a concert venue with only 100 physical chairs, but 5,000 tickets sold. The system works smoothly as long as people don't all show up at once expecting a seat. Some analysts believe the paper silver market may be dozens of times larger than the actual physical silver available. That means for every real ounce sitting in a vault, there could be many paper claims tied to it. As long as most people are satisfied holding paper, the structure holds together. But if even a small portion of those holders suddenly demand the real metal, the entire system starts to strain. This fragility is baked in from the beginning, even though it's invisible during calm periods. The second stage is expansion. This is where the gap between paper promises and physical reality grows wider and wider. Debt balloons, money printing accelerates, and yet prices of certain assets remain strangely subdued. This phase has been playing out since the financial crisis of 2008. Central banks printed trillions of dollars and pushed that liquidity into the global system. It's like adding more water to a pot of soup. The volume increases, but the substance becomes thinner, so each unit of currency buys less over time. Despite this flood of money, silver's price stayed relatively contained for years. Many observers argue that whenever demand for physical silver began to rise, large financial players dumped massive amounts of paper contracts into the market. That extra paper supply kept prices capped for nearly a decade. But while the paper market was doing its job, something very different was happening in the real economy. Industrial demand for silver started rising sharply. Solar panels require silver for conductivity. Electric vehicles use far more silver than traditional gas-powered cars. 5G infrastructure, data centers supporting AI, medical equipment, and advanced electronics all rely on silver. This demand isn't optional or speculative. It's foundational to how the modern economy functions. Over time, industry began consuming a much larger share of global silver supply. A decade ago, industrial use accounted for closer to 40% of demand. Today, it's closer to 60%. At the same time, supply wasn't keeping up. Silver production hasn't been able to grow fast enough because most silver is mined as a byproduct of other metals. For several consecutive years, the world has used more silver than it has mined. This creates what's known as a structural deficit. In simple terms, society has been drawing down existing stockpiles, vault reserves, and above-ground inventories. Those reserves are finite, even though paper markets make them look endless. This is where JP Morgan re-enters the picture. Market reports suggest the bank began accumulating large amounts of physical silver years ago. Some estimates put their holdings in the hundreds of millions of ounces, more than what famous historical players once controlled. This raises an obvious question. Why would a major bank quietly accumulate that much physical metal? Years earlier, JP Morgan had reportedly been positioned against silver and ended up paying penalties related to market practices. After that, many observers believed the bank changed strategy. Instead of fighting silver's rise through paper exposure, it began covering those positions and buying physical metal quietly over time. While paper prices stayed muted, physical supply kept tightening. That gap between paper valuation and real-world scarcity has never been wider, which makes the entire structure increasingly unstable. The third stage in the pattern is the break. This is the moment when something finally snaps. It could be triggered by a technical failure, a political shock, or a sudden loss of confidence. When it happens, people stop trusting paper promises and start demanding the real thing. Everyone with a paper ticket rushes to claim one of the limited physical seats, only to discover there aren't enough to go around. There are signs this stage may already be unfolding. Recently, a major exchange that handles paper contracts experienced a system outage that froze trading for hours. The official explanation was technical, but the effect was revealing. When systems came back online, physical silver prices jumped sharply. That kind of reaction shows how sensitive the market has become when paper mechanisms are disrupted. Shortly after, JP Morgan reportedly reclassified a portion of its silver holdings. In exchange terminology, silver that is registered is available for delivery, while eligible silver is stored but not for sale. At a moment when demand was peaking, a significant share of deliverable supply was moved off the market and placed into storage. That decision reduced available supply during a shortage, which raised eyebrows across the market. At the same time, borrowing rates for physical silver reportedly spiked. People were willing to pay extremely high interest rates just to access metal for a short period. That kind of behavior doesn't happen in a healthy market. It signals desperation and stress, which are classic markers of a system under strain. This brings the process into the fourth stage, the eruption. In this phase, price movements are no longer gradual. They become fast, volatile, and emotional. Paper claims begin to lose credibility, while physical assets command large premiums. Many people are left holding contracts that don't translate cleanly into real-world delivery. To understand where prices could go, it helps to look at history. In the late 1970s, two wealthy brothers famously accumulated large amounts of silver as inflation surged and supply tightened. Silver rose dramatically in a short period, only to collapse after rule changes were introduced that restricted buying. The squeeze itself was real, even though it was ultimately stopped by intervention. When adjusted for inflation, those historical prices would be far higher in today's dollars. Silver also has a long-standing relationship with gold, measured through a ratio. Today, that ratio is far from historical norms, meaning silver is relatively cheap compared to gold. If that relationship were to normalize, prices could move much higher without requiring any extraordinary assumptions. This isn't about conspiracy theories, but about what happens when paper markets are forced to reconcile with physical reality. Another factor looming over all of this is monetary policy. Central bank decisions, especially around interest rates, can act as catalysts. When rates are cut, currencies tend to weaken, and hard assets historically respond by moving higher. Gold often moves steadily, but silver tends to react faster and more violently. That difference is why silver is often compared to a speedboat, while gold is likened to a large ship. One important detail is the gap between screen prices and real-world prices. In times of stress, the price quoted on exchanges can diverge sharply from what people actually pay to obtain physical metal. Premiums rise, availability shrinks, and the quoted price becomes more symbolic than practical. That dynamic has already appeared in past crises. Stepping back, silver itself may not be the core issue. It acts more like an alarm. The deeper problem is confidence in paper systems and currencies that are backed primarily by trust. After decades of debt expansion and monetary easing, that trust shows signs of strain. Gold, energy, and other hard assets are sending similar signals. Silver stands out because it's both a monetary metal and an industrial necessity, yet it has been overlooked for years. When long-term pressure finally releases, the adjustment can be violent. It took decades for silver to surpass its old highs, and that long buildup increases the intensity of the move when it finally happens. Past players who acted early were crushed because they fought the system. Institutions that understand the system tend to position themselves quietly and let structural forces do the work. What's unfolding now looks less like coincidence and more like convergence. Years of paper expansion, tightening physical supply, rising industrial demand, and shifting monetary confidence are all meeting at once. The setup is complete, the expansion has run its course, the break is underway, and the eruption phase is loading. Whether this plays out fully or is delayed again remains uncertain, but the pattern itself is hard to ignore.
At 11:47 p.m. Eastern Time last night, 3 of the world's largest bullion banks simultaneously updated their customer account terms. No press release, no public announcement, no warning to account holders, just a quiet change to the fine print that restricts how much physical silver customers can withdraw from their own accounts.
If you think banks freezing silver withdrawals overnight is just routine compliance or risk management, think again. The reality is far more serious. Banks don't coordinate major policy changes at odd hours unless something is fundamentally wrong, and recent events show a pattern that should make anyone holding paper silver pay attention. Over the past 72 hours, the COMEX inventory reports indicated another 12 million ounce drawdown. At the same time, anomalies appeared in the London Silver Fix, with morning and afternoon prices diverging by over 3%. Then there was the emergency LBMA meeting on January 12th, which wasn't even listed on any public calendar. When you connect these dots, it paints a picture of systemic strain in the silver market. Let's start with what actually changed in bank account terms. 3 major bullion banks, HSBC, JP Morgan Chase, and Scotiabank, quietly updated their precious metals account policies almost simultaneously. On the surface, the public explanation was the same for all 3. Routine risk management updates, standard compliance tweaks, and operational flexibility enhancements. But the reality hidden in the fine print is different. Take HSBC, for example. Their updated terms now state, the bank reserves the right to limit withdrawal requests for physical precious metals to quantities determined at the bank's sole discretion, subject to availability, market conditions, and operational capacity. That phrase, subject to availability and market conditions, is new and wasn't there 6 months ago. In plain language, this gives the bank unilateral authority to deny customers withdrawal requests, even if the account shows silver in your name. To understand why this matters, you need to know how bullion bank accounts actually work. Most people assume that when they buy silver through a bank, their metal is sitting in a segregated vault somewhere, physically allocated to them. That's not how it works. Most accounts are unallocated. When you buy silver, you don't own specific bars, you own a claim on the bank's general pool. The bank credits your account with an ounce figure, but there's no guarantee that specific metal is set aside for you. Banks run these accounts fractionally, similar to cash in regular bank accounts. They assume that not every customer will demand physical delivery at the same time. It works fine until demand spikes, and that's exactly what's happening now. Over the second half of 2025, withdrawal behavior shifted dramatically. Physical silver requests surged roughly 340% between September and December. This wasn't gradual growth. It was a structural change in the way customers were interacting with banks. 3 factors drove this shift. First, retail investors who followed events like the GameStop saga and the London Metal Exchange nickel debacle realized that paper claims can become worthless overnight if the underlying asset isn't actually there. They started demanding real physical possession instead of trusting counterparty promises. Second, industrial buyers, particularly in solar panels, electronics, batteries, and medical devices, began forward purchasing much larger volumes. Instead of relying on just-in-time supply chains, they wanted immediate delivery to avoid potential shortages. Third, 2 sovereign wealth funds discovered discrepancies during audits and demanded full withdrawal of their holdings. When sovereign funds lose confidence in bullion custody, that's a major red flag that echoes across the global institutional silver market. This has set the stage for a structural imbalance. According to LBMA data, Total silver held in London vaults is about 873 million ounces. Meanwhile, estimates for unallocated silver claims against these vaults range from 3.5 to 4.2 billion ounces. That's roughly a 4-to-1 ratio on the conservative side. Some analysts who factor in derivatives put the ratio at 6-to-1 or higher. The math is simple. If even a fraction of claim holders simultaneously demand physical delivery, there isn't enough metal. Current trends suggest we're approaching 27% delivery demand. That's just 3 percentage points from a threshold where the system can no longer function. This structural imbalance didn't happen overnight. It unfolded through a series of stages over the last year and beyond. Stage 1 began with premium divergence early in 2025, when the price charged by dealers for physical silver split dramatically from the paper futures price. Stage 2 was marked by delivery delays. Mints and refineries, which used to deliver in days, started quoting 8 to 12-week lead times. Stage 3 introduced mint rationing. The U.S. Mint, Royal Canadian Mint, and Perth Mint all implemented allocation programs to limit how much silver dealers could purchase. Stage 4 saw industrial panic buying, with solar manufacturers and electronics companies forward purchasing 6 to 12 months of supply instead of the usual 30 to 60-day cycles. Stage 5 drained ETF inventories. SLV and other silver ETFs lost more than 180 million ounces even as investor interest rose. And now Stage 6 is unfolding. Institutional access restrictions, where banks can legally limit your ability to withdraw money from accounts you believed were fully backed. Each stage has occurred faster than the previous one. Stage 7 price discovery breaking and the paper market disconnecting entirely from physical reality is looming closer than most people expect. When that happens, the paper price you see on screens won't reflect what people actually pay to get real metal in their hands. History shows that such dislocations can lead to massive premiums for physical silver, creating a scenario where ordinary investors and industrial users scramble desperately for metal that simply isn't available. So why are banks making these legal adjustments now? It's not just caution, it's recognition of a structural problem. By adding terms that let them deny withdrawals based on availability and market conditions, they're protecting themselves legally against scenarios that have become increasingly likely. It's a preemptive hedge against a system-wide silver run, similar to how fractional banking protects cash reserves, but magnified because of the unique dynamics of silver supply and demand. The underlying cause is straightforward. For decades, banks have managed a paper-silver market that vastly exceeds the physical supply. Paper contracts allowed prices to remain artificially stable, but industrial demand, technological applications, and investor interest have steadily drawn down real inventories. Manufacturing, solar panels, electric vehicles, electronics, and medical equipment now consume a majority of silver output. Mines cannot keep up, and over the last several years, global consumption has consistently exceeded mining production. Stockpiles are being drawn down to cover the gap. Meanwhile, the paper market has grown exponentially, creating a scenario where there is far more claimed silver than actually exists. Banks have been aware of this for some time. That's why major players like JP Morgan have quietly accumulated massive physical holdings, effectively hoarding the metal while the paper market gives the illusion of abundance. Now, as industrial demand and investor withdrawals increase, the fractional system is approaching a breaking point. The newly added legal language and account terms acknowledges this reality. Banks can now withhold metal when conditions are tight, which is essentially a recognition that the paper market cannot guarantee physical delivery anymore. For individual investors, industrial users, and sovereign funds alike, this is a turning point. The system has moved from a period of relative calm to structural stress. Physical silver is increasingly scarce. Withdrawal requests are rising, and legal protections now exist for banks to refuse delivery. That's a dramatic shift in the silver market's operating rules. It signals that what was once theoretical risk in paper silver is now a tangible concern. If delivery demand continues to grow, and if industrial and sovereign withdrawals accelerate, the market could reach a point where paper prices become almost meaningless compared to the actual cost of acquiring physical silver. In practical terms, what's happening now is a confirmation of the shortage rather than the beginning of it. All the stages leading up to this premium divergence Delivery delays, mint rationing, industrial panic buying, ETF drains culminate in institutional access restrictions. This is the moment when banks stop pretending that enough physical silver exists to cover all claims and instead legally protect themselves from the consequences. It's a turning point in the market that will shape prices, access, and industrial supply going forward. So the takeaway is clear. This isn't routine risk management or minor compliance adjustments. It's a structural realignment. Banks are recognizing that the physical silver supply is constrained and that paper claims may not be fulfilled in a crisis. Withdrawal rules are changing to reflect that reality. For anyone holding unallocated silver, following industrial demand trends, or relying on paper claims, this week marks a fundamental shift. The fractional system that has sustained silver trading for decades is being stress-tested to its limits, and the next stage's price discovery breaking and a potential physical squeeze are approaching faster than most expect. And that's that for today's video. Thanks for watching, and we will see you in the next one.